Good evening to all. Today we will discuss about futures and options. Let us all pray that there will be a good knowledge
If
sharing.
there is one Mr. Kapil Kumar who has joined from two devices, I would like him to leave one device, please, so that anyone else who wants can join. Mr. Kapil Kumar.
So, see, this is a small example. The people are coming in, children are coming in buying mangoes. Okay. These are physical mangoes which they buy with the money and they give it to on exchange of money. So they come, get the mangoes, give the money, and they go. The transaction is complete. Now there is a small people who are seeing this. They are telling that the next person will come and buy at 20 rupees because the bargaining in that shop is going on. It may be 21, 20.5, 19 rupees like that. So these people are entering into a contract saying that the next person may buy at 21. The other person is saying that he may not buy at 20, he may be buying at 19. So one person is buying the contract, another one is selling the contract. So as per his wish, if the next bargain happens at 21 or 22, the buyer of the contract gets the profit. So this is how in India futures are being traded. The cash segment market is something which is happening where the shares of one is being transferred to the shares of others through proper demat account and CDSL, NSDL, so many regulations, and everything is documented. Similarly, futures are nothing but contracts which are just being traded similar to the price variations of the underlying. So concept 1 we understand is futures are just contracts. Now there are some features of these futures. Let us start one by one. So you have two prices. One is the one which we are trading, which is future price. Another one is the spot price. What do you see here is nothing but baskets of mangoes. When you go to these godowns, you can't buy one mango, two mango. You have to buy it as a basket. So similarly, these contracts are being traded in terms of lots. There is a separate lot size for each Nifty, Bank Nifty, like that. So all these are lots. Now anything which we take, there will be a validity. See, this hall ticket is valid only till the exam period is over. Now all annual exams are over. So all these contracts also have some expiry date. So there are 3 expiries in India for futures: current month, next month, and the farm month. And even if you buy a chocolate also, you have an expiry date. Beyond that, the chocolate is invalid. Even if they give for free also, you will not be able to buy. So these are some features of the futures trading in India. There is another concept called MTM, which is called mark to market. So how this mark to market is, they debit a margin from your account. Say this is consisting of 2 components. One is span as well as another one is exposure. We will have clear examples to understand all these things. As of now, we will understand that this contract which you made between 2 persons, you can exchange with some other person. Anybody wants to go out, they can go and they can hand it over to another person. So contracts are tradable. Futures can be either in premium or it can be in discount. What is premium, what is discount, we will be seeing with a clear example. So since you are buying lot size, say Tata Steel with some lot size, you will not be able to get the dividend of that because we are not holding the underlying. Another thing is, whenever the contract is nearing expiry, we have an option to roll over. So the number of contracts which are open, how many, like this millions of people will be buying, selling, it is called open interest. These are all small terms. So here if you see Here if you see the stock close price is 585, but the futures price is 601, which is almost 16 rupees higher than. So what is happening here? The people are bargaining that the next trade will happen at 601. So they are almost trading at a speed of 16 rupees when compared to what is actually trading in the market. Such scenarios are set to be in premium. When such scenarios happen, future contracts are set to be in trading in premium. Similarly, discount. The contract previous close is 846, today's close is 844, and the actual price stock close is 855. The stock is trading at a value of minus 11 rupees less than this, which is 844, whereas the stock close price is 855. So this scenario, when it happens, you just check whether they are declared any dividend. If there is any declaration of dividend, then this is acceptable, or else the discount we have to be little careful. So now coming to MTM. If you have to place one order buy in futures, you will have to spend this much as money, 1,61,000. This is called margin money. This consists of span margin. Another one is called exposure margin. The span margin, there is a separate algorithm which is run and explores the market volatility, and based on that, this margin is fixed. During highly volatile condition, the margin will increase, and low volatile condition, the margin will decrease. All these basic things, whatever is required alone, we will be discussing, so that it will be easy for us to know what we are doing. Now let us understand what is mark to market. Let us say this person is long. That means he has purchased a futures contract, assuming that the price will go up. There is another person who entered into contract. He is short. That means he sold a future contract. That means these two persons agree. Currently the price is 1000, means they agree as 1000. If it goes to 1005, this person will get profit long. If it goes to 995, he will get some profit. That's all. So they can enter at whatever price they want. After some time, another two persons will come. Price will be 1002. Again, new contracts may be formed. So there is no limitation at all. Any instant, these contracts can be created at any price. So both give money to SEBI or exchange or broker. He deposits 1,61,000. He deposits 1,61,000. Now what happened? Nifty increased by 100 points. So 75 is the lot size for Nifty. So what they will do? He will be credited with 7,500 and he will be debited with 7,500. So at the end of the day, his balance will become 168500. His balance will be 153500. Now this happens at the evening. So morning 9:15 he has to come with 1,61,000. Next day morning also he has to again come with 1,61,000. So this 1,53,000 is the balance. He has to top up this 7,500 rupees when he comes to next day morning. So if you take the ledger balance of futures trading, so there is Mr. Anish, you want to say something? Okay, thank you. So next day 9:15 AM both have to again come with 1,61,000. Now
No sir, I think audio was a little unclear.
Okay.
That is all what I wanted to say.
Okay, sir. Okay. I am just. I am already. I'll check my mic. Now, are you able to hear?
Yeah, you are audible, sir.
So now every day morning both has to come with 1,61,000. This is called mark to market. That means your daily fluctuations are being settled along with your account on a daily basis. Why they have fixed 1,61,000? That means if Nifty falls by 2,146 points also, this person's amount we can completely wipe away from him and give it to him. That's why they are charging you 1,61,000. So if SEBI feels that Nifty will fall by 5,000 points, they will again claim you more margin from you. So based on the volatility, the margin money will be keep on fluctuating and varies from stock to stock. So now we'll come to what are the types of market participants. Only there are two people. One who's with money, another one is who purchased some contracts with this money and now he is having some position. That's all. Only two people. Either you have money with you or you have contracts or futures or positions or shares or something with you. Now this person who was with money, they will either be waiting to go long or they want to waiting to go short. There are another category of people who will always be waiting with the money. They won't be any having undecided. Whichever side breakout happens, that side they will jump. Those who are with position are nothing but those who entered long or short. So they want to now exit their long positions. Either they may be in holding in profit or they may be in loss, but they want to exit. Here there may be case of persons who are having short positions. They also want to exit either in loss or in profit. So only this is the universe with which we are dealing with. So within these people only, emotions of these people only will be driving the market. So some they will be taking leverage, some they will be taking intraday margin, like that. So many people will have so many emergencies to exit or enter at whatever price they get, which will drive the market orders and market prices. So coming to open interest. So as I said, there are set of people who want to go long, they are ready to buy. Similarly, there are set of people who want to go short, they are ready to sell. Now what happens, once they place a buy order for at price P and the order gets executed, they form two contracts. Now you have another two category of people. The open interest becomes two. That is, whoever has purchased, they are long, and whoever has short, they are coming and holding shorts. Now you have four types of people, and these people are again waiting to buy, and these people are again waiting to sell. They are deciding based on market movement, they will enter or exit, they will decide. Now what happens? Price increases. So seeing the price increases, another two people are entering. Now the open interest is 4. Okay, from 2 to 4 it has increased as price increased. So this is called long built up. That means as open interest increases, price increases, open interest also increases. Now where this buyers will be, all these people have purchased, no? Now they will go and join this selling queue. So they will enter into this selling queue. Similarly, these people who have sold, no, they will go and stand in this buying queue because they want to exit their short positions. For that they will be ready to place buy orders. So this is how they will exchange their positions. Now price is still increasing. What about these people? They will be in pain. Already they are short. Now price is still increasing. What about these people? They will be happy. They will be in profit. They will be in green. Now who will exit the market on an urgency? Only these people will place market buy order and they will exit whatever may be the buy. They will have some limits, no, stop loss or whatever, the margin triggered, shortfall is something. So they will place market buy order, exit. These people, they won't price market price. They will put a target 50 paise above and they will sit. If it hits, no problem. Or else they will put a stop loss, stop profit order and they will sit. So these are the market orders, these are the limit orders. That's how the orders get executed and you lose some contracts. Now as price increases, due to the pain of the shorts, the contracts get closed. This is called short covering. Now again the same scenario, when price falls, you again add some more people. As price falls when open interest increases, it's called short built up. Similarly, when price falls further, who will be in profit? Shorters will be in profit. When buyers exit, this is how they will place their orders and they will exit, wherein you will see a small pullback. It will be falling heavily, suddenly you will see a small pullback. So this is what is called long unwinding. People who are long, they are unwinding. These are the 4 activities which majorly happen in the futures contracts. Now coming to the same. The same mango people, they are buying, selling, okay. These people are coming here, buying, selling, no problem at all. Now what happens if these people keep on creating contracts without any limit? Assume there are only 1000 mangoes, but these people are trading for 10,000 mangoes. So if this goes, no, it will be a scam. So the purpose of future contracts was itself to protect the traders or vendors with a guaranteed price. That's called forwards, but there was a counterparty risk. Now everything is cash settled. So when such situations happens, like excessive contracts are created, there is a parameter called MWPL, which is called market wide position limit. When this limit reaches 95%, further no contracts can be created. That time the stock will be declared as banned. Whoever holding the contracts, they have to exit. Until it falls below 85%, nothing will be done. For upper limit it is 95, for lower limit it is 85. So people have to shut down their positions and they have to come down. When it comes to 85% of the applicable MWPL limits, then stock will be released from ban. So this is the basic concepts which are available in futures. There is nothing complicated much in futures at all. Just as an introduction, we have gone with futures. The next area is what more interesting, which is options. Again, a small example. If everyone knows here this, then we will just go it in a fast way, or 1 or 2 minutes we can spend here. So this is nothing but a house which is trading at 25 lakhs. He gives a 5 lakhs advance, and this is a not an equally agreeable or equally liable contract like futures. This person can run away after giving the 5 lakhs, but this person should keep on waiting. Whenever this person asks, he has to sell only at 25 lakhs. This person can give the 5 lakhs and he can run away without buying also, but this person, if he asks, he should sell to him only at 25 lakhs. But one cushion he gets is he need not repay the 5 lakhs and bonds. So this scenario, like 40 lakhs if it goes, he will be with 10 lakhs profit. He will be with 10 lakhs, he will be in profit. He will be missing the 10 lakhs. It's an opportunity loss for him. But practically in contracts, when we options are getting in the money, we will get losses. For an example, this is an opportunity loss. For him, it's a opportunity gain, wherein he can sell it at 40 and he can gain 10 lakhs because his cost is 25 plus 5, which is 30 lakhs. Now if it falls below 20, 25, he will run away because he may not know whether the IT company will come or not, so he will run away. Now if it is 30, both are happy, both will be happy and they will be at break-evens. Now all this information will be converting into graph. Henceforth all understanding will be only through graph. Ideally, moment price goes above 25, there is a chances for the buyer to get profit, whereas he has paid already an advance, because of which the 5 lakhs is the break even. Only it goes beyond 30, he will get real profit. So what is then happening between 30 and 25? His loss is slowly reducing. After that, his profit is starting. Similarly, for seller, if you see, he is getting a 5 lakhs. As long as price stays below 25, So this is, you can ignore it. 15, 20, 25, he will get profit, which is nothing but the advance received. Beyond that, what is happening? His profit is getting reduced. After that, he will enter into loss. The same scenario will be happening in options also, but we have 1 or 2 or 3 terms extra when compared to features. So what is that? Same. Here premium means the amount of money you give as advance. Another concept is strike price. In futures, every tick of the market you can keep on creating contracts. Whatever you wish you can do. But here you cannot create like that. You have specific prices at which the buyer and the seller can agree to exchange the underlying at that price. That price is called strike price. Here you need not tell what is your direction. Simply you enter long or short. That's all. But here we have to specify whether you are expecting to go up or go down. So you have 2 options. One is call and put. Additional same expiries are applicable here. In index you have additional call, weekly, quarterly and yearly expiries. So one major point is margin is different for buyer and seller. So coming to expiry date, see, as we told, you have 1st April, 8th April, 15th April and even 2021, even 2025 also we are having 3 years also people are trading. So this is the way we have to understand the expiries, because long dated options are also available, whereas in futures it is not available. Coming to strike price. What is the strike price? People are running towards a line. There is only 2 options. Either you cross the line or you stay behind the line. If you come close to the line also, they will not give you price. Only if you cross, they will give you price. Rank 1, rank 2, rank 3. So the underlying will be running. Once it crossed the strike price, it will have some value. If it didn't cross, it doesn't have any value. Even in exams also, 36 is the pass mark. If you score above 36, you are pass. Or else, even if it is 34.5 also, it doesn't have any value. Similarly, we have strike prices in our options. For example, let us take 15,000. That means at this strike price, I am ready to exchange the underlying. Now, all these theoretical concepts you would have read somewhere. Only point you have to understand is CE means right to buy at lower price. That's all. Tata Steel is trading at 1000 means somebody is agreeing to give you at 700 rupees. Right to buy at a lower price. These 3 terms alone you can understand. So this person is nothing but forced to sell. So he will be forced to sell at a lower price. That's all. For him it's an option. That's why it's called option. For him there is no option. He has to agree. So basically it's a buyer side favored contract, and seller he has to pay hefty margin for that. For him it's nothing. Whatever is the premium, 3,750 rupees, he will pay if the premium is 50. So the same thing which we discussed for a house example is happening here. Here the value is 11.25 lakhs. But if you see, one person will pay only 3,000 and the other person will pay heavy margin. That I will show you in next slide. So what is the required margin? 15,000. If you sell, you need 1 lakh, 10,000 as PAN, 23 as exposure. Total is 1.33 lakhs. How much is the other person paying? Just 3,750 rupees. Now whatever we are going to discuss is going to happen on the expiry day 3:30 p.m. Okay, we are going to divide our discussion into 2 parts. One is what is happening at 3:30 p.m. on the expiry day. The other part will be what happens before, the moment you execute the trade, what happens. So this is what happens. 7,500 he will get if Nifty increases, whereas he will get debited, and that day expiry day market is closed. Next day if he want to carry a fresh short, he has to switch the contract and again he have to pay margin. So how much points? 1773 points they may crash or go up. That much margin they are getting in advance from the shorters. This is the place. This person is a small person, only t-shirt is wearing, only with 3,750 he will come. This person with so much money, he will come 1.3 lakhs and he will give 7,500 if price increases. Now how these people are going to hedge their losses and play safe games is what we are going to discuss for the next half an hour or 1 hour. All these informations I am converting into graph so that our understanding becomes simpler. So same concept here, the entire period, if it stays below, he has to lose 3,750, which is 50 rupees. And same here, if it stays below, seller will get 50 rupees, not more than that. Beyond that, this person will give unlimited losses. Now, similarly, you have an option called put option. What is this put option? You just remember this word, right to sell at a higher price, that's all. So, if Jet Airways is, S Bank is trading at 10 rupees, somebody is agreeing to sell, buy from you at 50 rupees, how you will feel? Very happy, no? Similarly, this put option is such an option. Whenever price falls, we can just stop it at a fixed sum price and you can put a contract there and make someone to buy from you at a higher price. This is the right for the buyer. All these are not whatever we have discussed, no, these are not something which are created for trading purpose and all. Everything has a real life example. We'll have more and more interactive examples as we go further. So if you have insurance, some damage happens, we claim. If it doesn't happen, that money is an non-returnable money. It's like a loss, but we don't regret for that. Similarly, health insurance. What happens? You pay some 10,000 against some cardiac arrest or whatever, or some cataract or whatever. So as long as you are safe, you are blessed. If you are not claiming that, what happens? Someone else in this world will be claiming it and you are helping them by paying an insurance premium, so that the company helps indirectly by your money to someone who is suffering. So that's how the health insurance business works. So all these are nothing but examples of put options. Same example, you have 15,000 PE. Now the direction of the price is downwards. Once it crosses 15,000 and falls below, you get good profit. And once it crosses beyond, below that, you will be losing the premium paid. All you have to understand is there is a region where your payoff graph is not changed at all. This is something you have to concentrate. Up to this region, whatever happens, the property or the nature of this payoff graph is not changed. Beyond that, what it does, it tries to push the payoff graph up. So you have a small loss producing region, then profit increasing region, then you have a constant risk region. Now this is the seller scenario, just mirror image of what happened to buyer. So now coming to the question, whether underlying cross the strike or not, that's all. This person is jumping, no? If he jumped till this edge and all, they will not accept. Either you jump above that or you fail, that's all. So this gives us to a new topic which is called moneyness. Assume that the price crosses from 14,800 to 15,000. Now how many strikes it crossed? 700, 800, 900. All these strikes which it crossed, are said to be in the money. The one which is closed is called at the money. The other one are called out the money, because those who did not cross the lines, no. So these people who are waiting here, no, those people premium will be 0. For puts, whichever strikes price has crossed below, or it should fall below the strike price. Here it should rise above the strike price. This is called in the money. This is called out the money. Simple concept. Just you check any time whether price crossed or not. That's all. So these discussions which I am holding now are under the assumption that we are now standing at expiry day 3:30 p.m. So whichever options failed to cross, they become 0. Now one question, this 15,000 price, it goes to 15,200. What will happen? 15,200 will become at the money, and this will continue to remain out the money. These two will become in the money. So as price travels, the moneyness of the options also keeps on changing. This is one concept which you should understand. Moneyness changes. Now next question, underlying crossed or not, we understood. Yes, it is called moneyness. How much it crossed, that also we have to see, no? That is the next question. So I have taken an example, Nifty at 14,507 spot price. The strike which I have chosen is 14,400. How much it crossed? It crossed by 107 points. That means this 107 is the fair value. Then what about the remaining value? This is nothing but the time value. You buy something, you cannot pay only for the content within. You have to pay for the cap, you have to pay for the bottle. You go to a shop, you cannot claim, you have to give the tea till the brim of the cup. He will give some air bubbles also, and after some time the air bubbles may vanish. So what you are paying is in addition to what you are receiving. So this excess value which you pay is called time value, which is subjected to decay. Now how much is the time value here? 14,507, ideally 107. How much we are paying? 228. Excess is 101. 101 into 75 is somewhere around 7,575. This value is the time value. What is the meaning of time value? They are giving an expiry date. By 1st April, you should cross 14,400. Already he crossed, but suddenly he may fall also. So if he continues to stay above 14,400, then he will get the value. How much ever he crossed, that much he will get. He crossed by 200 points, he will get 200. Crossed by 300, he will get 300. This 107 which he has crossed, if it stays flat, it will close at 101. So this excess value will evaporate. Just you understand this, time value will evaporate. Coming to margin, this is 1.5 lakhs margin for 14,600 CE, and just an example to show you, to sell one lot, what is the margin. Now we will take another example, 14,600 CE. Now Nifty is at 14,507. I have taken 14,600 CE. How many contracts are there? 21,268. So 21,268 contracts trading at 102 rupees. Each contract is 75, which is almost 16 crores. Okay, this screenshot I took it on Monday or some Friday. So if you see the game which they are playing now, 16 crores will become 0 if price closes below 14,600. So usually you see open interest, you see premium, but if you multiply and see, then you will understand where it can go and close, such that the loss will be minimum. Now 1.53 lakhs, this fellow has to submit. 102 into 75, this fellow has to submit. So how much he is investing? 325 crores. So if somebody is selling an option for 21,000 contracts, 325 crores he has to deploy. Okay, he has to deploy 16 crores. This 325 crores roughly is how much? 32 is 10%, 16 is 5%. So within 1 week, either you gain 5% or you lose unlimited. Now a person with 325 crores, will you expect him to be so careless? What he will do, he will buy a additional one option, 15,500 call option. Let him buy. What happens if he buys? That will come separately. Now for understanding margin benefits, I am saying from 1.53 lakhs he came to 86 lakhs. Now how much you see? The same example. Instead of spending 325 crores, he is spending only 170 crores. So this is the nature of the option trading which is going behind. Like this, if you calculate for each strike price and if you total, it was coming around roughly on Wednesday morning, Tuesday morning when I saw, it was around 120 crores. 120 crores was the time value component alone in the all strike prices, which can either become zero based on the Nifty price, whichever strikes it crossed, they may survive. Other persons just gone, that's all, zero. So this leads us to next topic, wherein we have to understand these concepts from the option chain. So if you see where you will, suppose you have 1.5 lakhs and you know that if price crosses you will lose. Where you will go and write the highest strike, wherever you feel Nifty will not touch, that only we will write, no? So from a seller's point of view, they will try to put strikes wherever, put their contracts at strike prices wherever they feel price may not go. So last year and year before and all, this max OI strike only was very favorite for many people. They will take a stock option chain, see max OI strike, okay, this is resistance, this is support, and they will start going to trades with that. Off late, with help of hedging, all those margin reductions, now we have to watch whichever strike price, the second maximum is also concentrated. So for 1st April, if you see the OI distributions, the first rank is 14,000, second rank is 14,500. So they feel price will not fall below 14,000. So they have written 43,000 contracts. Next, some people are having some more energy, they are little brave, so they come and write at 14,500. These people, they are little less brave, so they are standing behind this wall. Let it break 14,500, then I will be cautious. So this is this is one concept wherein they just stand behind the 14,500 and they are waiting for 14,500 to breach, then they will react. Similarly, the call option sides, if you see, 15,000, 15,500, 14,700. Ideally 15,500 should be the highest, but if you see 32 and 49, how much? 17,000 extra. So they are feeling more confident, price will not cross 49,000, 15,000. So 50,000 contracts they have given at 15,000 strike price. Now if you want to get an overall picture, how many puts are written, how many calls are written, if you divide both, you get something called put call ratio. So just if you observe this, what is the understanding? how much is the total puts that is being written, how much is the total calls that being written. Just if you see as a number, it's okay, but you multiply by 1.53 lakhs, and if you imagine that many crores of money would have been deployed. In that aspect, if you see, it is 0.96. That means, okay, he would have deployed some 1000 crores, he would have deployed some 990 crores or something like that. So both are equally fighting against each other. This is the overall scenario. But now the same thing, we can try to find the energy levels at each strike price. So you can devise your own techniques. These are not standard, but if you want to see something different from others, you see the strike price here also. Change in OI, this also we can see. Call writing, put writing, call and vending, put and vending, the same points which we discussed for the futures, the same is applicable here. Because why the same point? This fellow will have 3,000 in his account or some 10,000 in his account and place buy orders for 3 lakhs. But a person who has to sell, imagine, he has to have several crores, no? Now only if he deploys his money and places sell order, these buy orders will execute, or else it won't get traded at all. So every option OI creation is under the mercy of option writers, assuming that they are spending huge money to establish the contracts. Now whether they are really having free cash and writing, or they are having the bonds as pledge and they are writing stocks as pledge and writing, that is next question. So they may even like we are at least spending 5,000 for paying the premium, but they may be not even paying 5,000, just for free they may write. One person is having 10 lakhs portfolio, he will get 8 lakhs margin, with that he will write 5 lakhs of Nifty free. That also is another scenario, but for the sake of academic discussion, we will understand that open interest is driven by sellers. Now, when he is risking so much, he will be very careful. Now let us observe this little patiently. This has many information. For the next 15 minutes, we will be discussing only about this. Market increased by 182 rupees. Every person is an option buyer here. Every person, the other counterparty person is an option seller here. What happened to call price? 102 rupees. Increased by 10 rupees. 130 rupees. Increased by 20 rupees. Market increased by 180 points and 14,700, only 50 paise. That too also loss. So there is something here, no? If call option gives profit, it should give profit. And market did not cross 14,900 at all. See, 14,500 only it is staying, but 14,650% also got profit. So all the discussions which we had so far was with respect to 3:30 p.m. expiry day. But if you see that one instant, if you ignore, 99% of the time we are trading with the away from the expiry only. So whatever definitions books give, no, that you keep aside. What is option premium? Now let us say today we have 30 days. For 30 days time, your strike price is 800. So now it is 500. For 30 days time, this is 1st April. Assume that you are in February 28. You have 1 month time. For 1 month, 30 days time, 300 points distance, and the volatility here it is 20.65. There is something called IV, I will explain. For the amount of volatility which Nifty is going to oscillate, for the oscillation, for the time available, and for the distance which you have to run to reach your strike price. You are betting on these three items for which you are deciding this premium. So just by seeing whether price crossed or not, or whether open interest increased or not, all these are not the deciding factors for the option prices. So there is something which we need to understand about option pricing. So each and every values here we will try to qualitatively understand why these are happening. So now this helps us to know how options premium are priced. For this I'll just take you lightly through option Greeks. This will help you to understand why there is a variation in each strike prices. So Nifty increased by 182 points. This fellow 64 rupees 14,700 got how much rupees? 2 rupees increase. This fellow 223 rupees got 50 rupees increase from his previous day. Okay, so for 182 rupees movement, each person is getting different gains. The premium values also more, for some it is less. How much each person should gain for Nifty movement? That is called delta. Don't complicate much or confuse much. If Nifty increases by 1 rupee, how much you will get? 0.72 rupees you will get. That's all, simple. This is called delta. Now where Nifty is 14,500. So whoever is close to current market price, he will always be trading at 0.5 delta or 0.53, 0.5 to 0.55, 0.45 to 0.55 like that. So this person is always who's the one close to market price. Now if market goes to 14,700, what will be the delta here? 0.53 or 0.5 or 0.45, something around that. So how much a person should gain is decided by delta, and how much the delta should be is decided by the next governing factor, which is gamma. So 14,500 gives 0.53 rupees gain for every 1 rupee. He is giving only 30 paise. Now market moved by another 200 points. Now this person who was giving 30 rupee, 30 paise, now he has to give how much? 50 paise. So you are having a small plant, it is giving 2 tomatoes. Once it grows, what happens? It will give 5 tomatoes. So somebody put manure to it and make it grow, no? That person is gamma. He will change the delta of that person and he will make it to be more profitable. Same time, if you put excess pesticides, the plant will die also. So this gamma will always maintain the equilibrium. Wherever price is there, near to that whichever strike price is there, that price it will make it to give 50 paise for every 1 rupee movement. That's all. Not so many mathematical expressions and all will be there. We'll keep aside. So I'll repeat. Price moves by 1 rupee. How much strike price should gain? That is delta. Okay. Whichever is the closest strike price to spot price, he should always give 50 paise. If it is less than 50 paise, like 0.2 or 0.3, this gamma will make it 0.5. So you imagine this as a train. The train is running. Now it is 0.53. Next what will happen? Another 50 points. This will become 0.53. This 0.48 will come here. 0.42 will come here. 0.36 will come here. Another 50 points if Nifty increased, this will come here. That's all. Simple. You imagine like a train going up and down. All these which I am telling is an example which is going to happen within a day. across days how delta changes, that we will discuss later. As of now you understand delta moves like a train. Person who pushes the train is gamma. That's all. Next is theta. You understand theta, it will be more practical examples will be very helpful. See, this woman or this mother or this person is selling flowers. Morning 6 o'clock if you go, you can get at 10 rupees. 8 o'clock at you go, 8 rupees. 10 o'clock you go, 6 rupees. After that, if the flowers are dried, what they will do? Even if they give for free also, you will not buy. So they are having an quantity which loses price every hour, every minute. Daily they are facing expiry days. Daily morning they have to enter, daily afternoon they have to exit. And they know the prices are going to decrease for sure, and they have no other choice. So this person is cutting the fruit and selling. If it is not cut, okay, at least 2 days. But once you cut, no, the insects will come. So they have to sell. And after some time, due to sunlight, all the water will dry up. That's all. Value will go. Before cutting, it is 100 rupees. But after cutting, they will slice it and put each piece 5 rupees or 10 rupees. But the moment it loses its value, gone. That's all. It will be 0 rupees. So every thing, if you see, it will keep on losing its value. This fruit, you see, if I go evening, they will give me 10 rupees. If I go at 9 o'clock, the shop will be over. All these old bananas they will give 1 rupee per banana. And if you go another 11 o'clock, no, everything will be on the roadside. They will dump it. That's all. Value is 0. So what is the strike price here? For him, the strike price is mouth of this person. If it crosses this mouth, no, that's all. The value is retained. Otherwise, it becomes 0 and goes to dustbin only. Like that, every Nifty is trying to cross all the strike price and go. Put option strike prices, Nifty has to cross, fall below and go. Call option strike prices, Nifty has to cross above and go. But unfortunately, Nifty can go in either one of the direction, or it can go left for some time, go right for some time, and finally somewhere it has to stand. But all the remaining persons, they have to go to dustbin only. So those options are called OTM options. Now, whether they will go in a single day, no. It will take 2 days to become to this condition. Likewise, every option premium will go day by day, slowly they will lose their values. This is decided by theta. Now coming to the most important, unseen but dangerous, which is called vega. What happens to the ticket prices? If the movie is well, black ticket they will sell 100 rupees ticket for 200 rupees. Okay. Now, what happens to the price of the flower on Deepavali, Ayudha Puja or Christmas or before sometime any Ganesh Puja or Pongal? Same flower they will sell 1 feet flower for 10 rupees, and that day they will sell for 40 rupees. Because that day is auspicious day, we have to pray to God, we have to give the flowers, we have to buy, even if they tell 100 rupees also, we will buy at least small quantity. So, how much price they fix is not only decided by time value, all these things, like this kind of demand or extreme conditions also, prices are hiking. This is also happening in our options. This is decided by vega. What happens to face mark prices and standard prices? Increase. HCL Tech, before the results, what happens? Prices go up. Like that, the premium prices also go up. This is called vega. Now coming to the same option chain, which we discussed a few minutes back. What do we discuss? Delta, gamma, theta, vega. Now I'll show these 2 slides. I will interchange frequently. We got this 50 paise, no? Nifty increased by 182 points. Okay, now see 14,700. So what is 14,700? Here, 0.3 delta. What did I tell? Nifty increases by 100 points means 0.3 rupees. That means how much? 30 rupees. 180 means how much? 180 into 3, 54 rupees it should have increased, no? But why it increased only 50 paise? Because the premium pricing is because of all these 4 factors. Now delta is helping the price to increase by 54 rupees. But this volatility, no? This Vega, if it drops, price will drop. If it increases, price will increase. So what happened? On that day, India VIX fell by 9%. Okay. If India VIX falls by 1%, the premium will fall by how much? 7 rupees. Now if it falls by 9%, how much totally it will fall? 9 sevens are 63 rupees. So delta is making to increase by 54 rupees. Vega is making to decrease by 63 rupees. So finally 10 rupees minus. Now again another factor, because of this 182 points movement, it's some decimal mistake, but you understand, no? Concept is Vega increased, Vega fell, your option premium fell, Nifty increased, delta did it work, delta did it work, delta has done its work, Vega also has done its work. 1 day time elapse. So how much is the time elapse for that day? Before that day, 12 rupees. So 12 rupees this fellow will decrease. 50 rupees this fellow will decrease. Another 36. So 36 into 182, if you exactly put, no, 0.4 into 18, how much? 32, 72 rupees. 72 minus 12 minus 63, minus 3, roughly around minus 3. So that's what happened around my 2 rupees here around on the end of day. This is end of day. So it's almost negligible. So roughly what I want to tell is option premium governed by 4 factors: volatility, gamma, theta, delta. Complex it may look, but all are practical. Day to day people are living with this. So never assume that these are all only for theory. I don't want to complicate myself by learning option Greeks. All these things and all you can set aside. This works in options. Now, market increased by 182 points. India VIX fell by 9%. So rising markets are mostly accompanied by falling VIX. Falling markets are mostly accompanied by rising VIX. I am using the word mostly because it happens predominantly. There are situations where VIX will rise, like Nirmala Sitharaman candle. Rising markets also will indicate fear. So when market rises and you are afraid that whether it will fall, then you will be having more fear. When market falls and you are afraid that it will fall further, then again you will feel rising VIX. Okay, it's a temporary correction, healthy correction. This fall will not sustain. Immediately it will bounce back. All these things if you feel, then it is a falling market with slight fall in VIX. Very rarely it will be rise in VIX. Now we will take monthly options. 14,700 trading at 300 rupees. Now market increased by 182 points. See 14,900, 32 rupees increase. So each person they will increase by some value. Try to understand what is volatility. 28% is the futures volatility, which means 28% of this is how much? Roughly 10% is 1,500, 3,000, let us say 4,500. 4,500 plus or minus Nifty can go. This is based on the historical fluctuations. Okay, but person who is trading, he is not feeling that it will go 28%. He is feeling only 18%. So what you feel that it is likely to happen in the next 10 days is called implied volatility. That is called IV. IV is what is in the mind of the traders, that in the next 30 days, if it will go into some range of movements which is equal to 18% move in a year. So 18% in a move in a year means 1.5% per month, roughly. You actually it is square root by 12, but you should understand that premium is based on the IV. The same delta, this and all are calculated values, manually calculated values using formulas. So now we had so many questions, no? Like Nifty, we told it should cross the strike price, then only we will get profit. All these things we did, no? Now we will come out of that 330 game. Now we will see what happens in reality. The moment it crosses 14,700, it should cross 300 points, then 15,000, then profit. But every day market is trading at 14,600, but we are trading at 15,300, making 10 rupees profit. All these are happening, no? It's because of Greeks. That also we understood. Now I told premium will fall every day. How it will fall? It will fall like this. If you are 6 days before this expiry, then you need not wait till 15,000. Even if it crosses by 14,900, 950 also, you will get profit. If you are having 12 days before the expiry, that means 2 weeks. Then when Nifty moves, you will easily get profit. 14,875, if it crosses itself, you will get profit. Because 300 premium will breach at this point. So this distance is 300. Now to cross this distance 300, if it crosses 14,875 itself, you will get the profit. Now what happens 3 weeks before expiry? See, now 24, that is 4 weeks. 14,725 is the break even. So what books say 14,700 plus 300, 15,000. Break even is strike plus premium. This is only in books. Practically, if you see, this will not be applicable at all. So break evens are dynamic. They change every day. So whenever you take options, try to understand all these things and trade based on the reality, real break evens. Okay. So this is assuming all this, whatever I have drawn this, no, I have considered theta, gamma, vega, all the factors I considered, and I have plotted these values. Okay, all these tools I don't have how to understand. Simple. The curve is coming here and then sharply it is turning here. You understand that it will be like a flat. Sorry. It will be like a curve. The curviness or the shape of this curve will be, this depth will keep on increasing, and finally it will come and reach this shape. This smoothness, initially you see it's looking like a straight line, then it will slightly bend at the in between, then it will bend well, then if you draw it one day, no, it will be very steep bend will be there. So this bending effect you have in your mind. Suppose my equity curve is like this, for example, payoff graph may be in any shape. In the next 20 minutes, we'll be seeing all the payoff graphs. If your payoff graph is like this, what will be the reality graph? This is on expiry day 3:30 p.m. only. We are not going to wait till that. Then why study about that too much? So just you understand that bending effect. What will happen? It will bend. After this it will bend. So it will be like this. Then before that, next day, 3 weeks before, it will be like this. 7 weeks, 6 weeks before, it will be very flat like this. Slowly this bending will come. No need to use any complex software and all. Just to understand that this bending effect will happen and finally it will reach this exact shape. That's all. This only all these tools are doing. So let us put it, whatever we learned for this 1 hour, we can put it in a separate folder and store. Now whatever we are going to learn, completely we can stay fresh. Whether crossing the strike price, all those things you forget. Okay, you are buying a call option. What does it do? If you don't buy anything, what will happen? If price increases, you don't get profit, you don't get profit, you don't get profit. If you buy a call option, what it does actually, at this point if you buy, after this point, your payoff graph is rotated up. So imagine that you are coming here, this point you purchased a call option. After that, instead of going like this, you will rotate up. But nobody will give the option for free, no? So you spend money. Okay. When you spend money, you are having 5 rupees, you buy one chocolate for 1 rupee. 1 rupee goes from you. What happens? Your value reduces. So, 2 things you understand. After the strike price, rotated up. After the buying, payoff graphs moves down. Similarly, if you short a call option, your payoff graph will be rotated down. But you will get money, no? Suppose you sell your one house you have and you buy new house. So initially you sell, you get 20 lakhs, 30 lakhs with you. So you have been credited. Whenever you get credit, your payoff graph moves up. So only 2 things I am asking you to remember. Short, rotate down. Sell, receive cash, move up. So short means rotate down, move up. Buy means rotate up, move down. Same for put option. You have to rotate it up. But if it is a debit, so it will pull down. Any debit transaction will pull down. Any credit transaction will pull up. So these 4 things only we are going to learn. In the next 20 minutes, we will be learning almost 15 to 20 strategies, but by remembering only these 4 thumb rules. If you want, you can write it in a paper and keep. It will be like a movie only, so you can watch. Nothing to worry. How to handle multiple lots? Anyway, it will take some time, but just you see. 100 points, if you buy 1 lot or 1 share of Tata Steel, increases by 100 points, how much you get? 100 points. So the slope is 45 degree. If you buy 2 shares, same 100 rupees move, your slope is like this. If you don't buy anything, this is very very important. If you don't buy anything, nothing will happen. Your payoff graph will remain flat or unchanged. Okay, it's not 0, it's unchanged. So the slope of this graph depends on how many lots you hold. The slope of the graph determines how fast you cross the strike price. These 2 things enough, nothing to learn more. So now getting ready, and just if you want, you can take a photo and keep. All graphs which we discussed only at 3:30 p.m. but don't believe that. That is not at all going to help. Trade based on reality. For that, understand the bending effect. Enough. Any buy transaction, cash goes away, it's negative sign, payoff graph is pulled down. Any sell transaction, cash is received, payoff graph goes up, that is a positive sign. We have to account in books of account, anything you sell, you receive cash, so you give it a positive sign. All the transaction affects break even. These 3 things only we are going to use again and again. Coming to option strategies, this is the favorite thing now. What you see in this picture, this cow can stand wherever it wants, no? But why it is standing here? Somebody will buy some leaves. They may miss one or two leaves at the bottom. When the loadman is coming and dropping the vegetables to the shopkeeper, one or two may fall down. At the end of the day, some things will be unsold, so they will dump it there. A cow, how strategically it is locating itself so that it catches a high probability trade of getting food. That is the strategy adopted by the cow. Not only this, anything if you see, they will have a strategy. They will not just like that sit in a roadside and wait. They will stand near temples, they will stand near hotels, they will stand near markets, and in case of festivals alone they will go street by street so that people will give food. So some poor cows are standing near dustbins also. So whenever you see cow, give some food for them. They are like our mother. See the small boy. The traffic jam may last or may not last. The signal may be there, may not be there. But that short time, whatever the car driver is willing, strategically in whichever car the windows are open, he is just trying to present his 15 seconds to 20 seconds of his time. He is doing his best to achieve his target. So whatever they do now, they are trying to minimize their loss. That's all. Then only they can survive. So we are also earning something from market. So we can try to help this type of children. So why we should trade? We should trade and get profit to help the people in the society. With this objective, you learn the strategy so that whatever gets us to the right location. First concept. Now the same example will be using 10 times. We don't trade anything, we don't get anything. No loss, no gain. This is the meaning of our curve. We are flat. We buy a call option here. Okay. What happens? Plus 1C. You purchased one call option. Immediately your portfolio will rise once price crosses this. Okay. Now, if you buy a call option 14,700, 300 rupees. 300 rupees will be lost. 300 into 75, 22,500. We will restrict to 300. For discussion, we will restrict to 300. What happens? If it crossed, you get profit, and it continues to get profit. As long as nothing is interrupting it, you will get profit, no problem. Now what I do, I sell a call option. What did I tell? We learned selling the call option pulls the graph down, rotates the down, pushes the graph up. That we will see later. First we will understand the payoff structure. Whether it goes up or down, that we will see later. We are doing true transaction. First price crossed this, rotated up. Then we sold a call option, it will rotate down. That's all. So this is the payoff structure of your spread. Okay. Whether it is long spread or short spread, we don't know. The break even also we don't know. We understand that if you buy a call option, your profits will increase. After that, it will be limited. Break even will decide how much credit or debit, whatever we did, based on that, break even will be there. So let us revise once again. You buy long, you account all this long in debit, lowers the payoff graph, and sell short, your money increases, raises the payoff graph. That's all. So this fellow is having two legs. What he is doing, one leg is keeping here, another leg is keeping here. So leg 1 is at 14,700, the leg 2 is at 15,000. So call is at 375, 15,000 is 222. So sell transaction, what we should do? Buy transaction, what we should do? Buy transaction is negative, no? Money goes from us, minus 375. Sell transaction, positive, money comes to us. Net transaction effect, I am not telling add, I am not telling subtract, I am telling net. That is resultant of both. Minus 375 plus 222, what you get? We don't know. Whether we purchase the spread or sell spread, how we know? Whether our pocket is emptied or it is still credited, that if you know only we will know. So what you get? 153 rupees. Whether it is taken away or given, minus sign, okay, because minus 375, you got 220 rupees only, but you spent minus 375, so you spent minus 153. So if you buy a call option, you lose 375 if it doesn't go after 330 of expiry. But now you lose 153 only if it doesn't reach 14,700 and above before expiry. Okay. So net, it is a net debit transaction. Okay. Minus sign. That means you spent something. When you spend something, what you would have done? You would have bought. So this is a long call spread. It is a bull call spread. That means you have purchased the spread. You have done a buy transaction because you have a minus sign. As a result of doing all these, you have a minus sign. Okay. Now we see 315 is the expected loss. 152 is because of this revised spread. If you didn't do anything, you will lose 315. Since you have done it 150. If you didn't do anything, you have to wait till 15,000. Since you have done, to get at 14,850 itself, you start getting profit. But what is the risk? You get 150 profit. You are not going to lose and all. We are not going to lose. But that profit till 15,000, if you, whether you did or didn't do also, you will remain same. Beyond this 15,000 only, you will be feeling the effect of missing this profit. So this gives you a reduction in loss as well as a compromised profit. This is how you have to study. Now how we can play with this? Parameter 1, the strike which you select and the spread width. Always you choose 14,700 or 14,600. You can choose 100 points, you can choose 200 points, you can choose 300 points. Okay, no matter. Similarly, you can deploy the strike at various points. You can deploy 14,600, 800. You can deploy, what is this? 14,900, 1,500. You can deploy 15,200 and 15,400. You can choose any spread you want. So parameter 2 is distance. How much distance from the strike are deploying your spread? When you study about spread, you have to understand both. You can also deploy a spread of 200 or 400 wide, some 500 points away from the market. So for each of this, when you say spread, you want profit. When you want profit and your direction is bullish, you buy call option. But if you do a spread, you reduce the loss. That spread where to deploy, whether close or far away, you decide. How much wide you should deploy, that also you decide. What is correct, what is wrong, we are not going to find out here. If we do this, what will happen? That if you know, then you know what to do. See, this is the case. Now, all I did is 14,700 I kept as constant. From 14,700, what did I do? I kept increasing. At 15,000 I sold the call option. So what happened? My payoff graph became flat. Now what I did, another option, same 14,700 I did, but I did not sell the call option at 15,000. I sold the call option at 15,100. Can you see this? Exactly 15,100. The payoff graph, instead of going like this, it got rotated down. So I hedged my position at 15,000, at 15,100, 15,200, 15,400, 300. All these cases, what happened? We should understand. First, as you move your spread with more, your debit increased, because option prices, how are they? As we go far away, you get less credit, you don't get much. Okay, so you have, if you spend 300 rupees, in that only 100 rupees you are getting credit, so remaining 200 is your profit. So as you increase the width, what happens? The graph goes down, 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 down. When the graph goes down, what happens to your break even? Goes far away, far away, far away. What happens to your profit? It gives more space for you to gain, but whether Nifty will cross this much. So you have to understand risk, reward, probability of profit. These two things, three things you have to understand. Next option, what we do? We keep constant spread, but we deploy at different sizes. Earlier what we did, 14,700, you see, after that price increased, it went till 15,000, after that it became flat. So what is the width here? 300 point width. How much I got? 152. Same 300 point width, I will deploy now at which strike? 14,900. You see, the moment it crossed 14,900, price started increasing. How I am hedging it? 15,200. So same 300 I am deploying at 14,700. Next time deploying at 14,900. Next time deploying at 1,500. Fourth time deploying at 15,300. What happens in these four cases? As you go deploy your spread far away, your loss is getting reduced. 152, 124, 90, 67. What happens to your break even? Obviously it will change. This is very visible. But what is the drawback here? In terms of reducing the risk, you reduce the risk, but you are giving assurance for the risk that definitely this risk will be into your account. That means you are trying to reduce from 152 to 67, but here you are accepting that 100% you will lose that 67, but here at least this 152 can become 50 or 25 or whatever. So this will be somewhere around 150. Why? You are going far away from the strike price. Nifty, tomorrow if it moves 100 points, if I say, everybody will agree. Tomorrow it can move 200 points. Okay, there are chances. If I say tomorrow it will move 600 points, mostly you will disagree. So probability of getting this profit which I show, which is lucrative, is very less. So this is the relation you have to understand. So this is an approach to strategy. Any strategy which you take, you just targeted these things. What happens every day, not the expiry day payoff graph, every day. What happens? Why I am deploying each leg? How each leg modifies the other leg. What happens to each leg as time elapses? What happens to each leg as price fluctuates? What happens to each leg if VIX changes? By adding each leg, how much break even gets shifted? What is the winning edge in my strategy? You ask all these questions before and after deploying a strategy. Then only you can travel. Or else it will be difficult to know what we are doing. With this approach, we will be now understanding more deeper. Now, earlier we talked call option, put option. Hereafter we will talk only spreads. Because when I say 41 rupees plus, it means it is a credit. When I say credit, it is a sell. That means you have sold something, you have bought something, but in net you have sold something which is bigger. That's why you got credit. So 41 means you sold 14,600 PE and purchased 14,500 PE. That's why you are getting 41 rupees credit. If there is a minus sign here, you purchased 14,500 PE and if this is minus 41, you purchased 14600 PE and you sold 231. So you are debited with minus 41. So you observe the spreads. What is this spread telling to us? If you do a 100 points wide spread, you can risk 21 if you purchase it. You can be rewarded to a maximum of 21 if you sold it. So now we are learning about buying spreads. So if you see the spread cost, as you go, only 5 rupees you will lose if you do this pair. Just 375 rupees. But anyone can confidently tell it will become 15,800 in next week or this month. We don't know. So just see the spreads. Spreads decrease as we go far in OTM. Spreads come to bigger values as we stay near ATM. Second thing you have to observe, what is the strike width? Nifty every 50 points, I have considered 100 points. So for 100 points, you are getting maximum how much? 50. You leave this in the money spreads, this doesn't have meaning. Maximum you will get 40 points. So 100 points is your width. You will not get more than 50% of that. That's how option premiums are designed, so that you don't make a risk-free, completely profit-giving system. That's how they design it. Premiums are such that any two strike price difference divided by 2, that value will not be more than that. Usually, you take any stock and see, it will be like that. Because the strike prices are fixed based on that and premiums are fixed based on that. Now for a buy, this is a debit, this is the risk. 21 rupees is risk, means how much is the reward? 100 minus 21, which is 79. 20 rupees is risk, means 80 rupees is reward. If you sell it, 20 rupees is reward, 80 rupees is risk. So now what we did before, we purchased a call option. To get some credit, we sold a call option. Now what we'll do, same thing. We purchase a call option, price is rotated up. We sold a call option, price is rotated down. Okay, rotated down. Two things only we are going to buy, rotate up, sell, rotate down. Now again, what I am doing, I am selling another call option to get more credit. That 150 rupees also I don't want to lose. So my payoff graph is rotated down. After that it will go and go and go down. It's the unlimited loss. So what are the combinations possible here? One is point at which you deploy this. Second is how much distance you see here. And third is how much credit you choose here. You can choose here, 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 or wherever you want you can choose. So this is a spread. This is an additional short call. So spread already you know, just now we discussed it. Call we can choose as we wish. Now let us say how much we get. 153 is minus sign. That means from our pocket we spent 153, which is at risk. Now how to reduce this risk? You can sell one more call option. Now in this, which call option you will choose? You will see 118. If you sell, what will happen? 153 by 118, it is 35 rupees. You have two rules. So what I will do, I will choose one call option and I will sell it. I am choosing 15,200. Okay, 149. So only 4 rupees is my risk on the downside. Earlier my payoff graph has only one break even. Now it has so many break evens. So now I will change all the combination and check it. So here what I have done, only 14,700 I have taken. For that I am buying 15,000 call option. See, separately, exactly at 15,000 I purchased. After that, this blue line is the example which we are drawing. Other lines I have just given you for additional examples. So what I have done, at 15,200 price started falling because of the sell call option. What is my break even? 15,500. How much is my risk? Only 4 rupees. Correct? I have given legends here. I don't know whether it is visible. 14,700. From there 300 points I am taking a spread. From there 200 points away I am selling another call option. Okay, 14,700 plus 300, 15,000 is my spread. From there another 200 points, 15,200 I am selling the call option. Now same 14,700 I can same 300, instead of selling 15,200 I can sell another 100 points away. That is also a good option. What is happening here? My risk is slightly increased. Earlier it was 150, now it is 50. Now it is 3, it increased to 30. So as you increase this option far away, you will get less credit. Less credit means what will happen? Your entire payoff graph will be lowered. You got more credit, your payoff graph is at top. You get less credit, you will be less. Very less credit, you will be down. You got very super credit, 14,900 itself you reduced the spread and you sold it, means this entire area is profit fully for you on expiry day. Before that, how it will look like? Just imagine that bending effect. It will be like this. It will be smooth. That's all. Overall, we have to reduce the risk. But still one person is asking me, sir, if it goes to 16,000, I will get 1,000 rupees, 75,000 loss. What to do? For that also we have an option. So what we do, same story. You buy a call, rotate it up, your price goes up, you sell a call, rotate it down, again you sell a call, rotate it down, price goes up. Now this unlimited loss you limit for the, you buy a call, you will rotate it down. So what is the purpose of this leg? To take credit. What is the purpose of this leg? To save my loss. What is the purpose of this leg? To reduce my input cost. What is the purpose of this leg? To specify my direction which I want to trade. What is the purpose of this width? To fix how much profit I want. What is the purpose of this width? To limit how much loss I get. What is the purpose of this height? To fix how much is my max profit possible. This entire payoff graph will go down or go up by the net credit or debit you receive. So this break even which you see may go slightly here and this break even may come slightly here. That's all. Like this you can draw your own strategy as you wish. So we are almost near 1.5 hours from the start. So I'll just try to conclude in another 2-3 slides. You can give your own name. Spread, this is called long condor with calls. What you can adjust here? This entire spread you can bring front, bring back. This spread width you can increase, decrease. This spread width you can increase, decrease. So you have 1, 2, 3 parameters. Multiple combinations you can make. So I have taken an example where I short 300 point spread and I buy 300 point spread. One I deploy it at 14,700, one I deploy it at 15,300. So how much I get? Net credit minus 85. So this is the examples for you. The blue line is always the example which we talk. The other things are extra options which we have worked out. So I have given you clearly this legend also. How much wide you take, after that how much gap you give, after that how much you. Now all you have to understand here is, when you try to, this spread is your target, you cannot touch this. Only this spread which you sold, no, this if you try to bring front, what it happens, you are getting lesser credit. So this 70, 21, 26, 31, all this, what is the meaning? As you come before, you will get more credit, but your loss will increase. See, you try to push the graph up by getting more credit. Let us compare these two lines, blue and green. What happened in blue and green? Same graph, same strike, but what happened? Here you sold your call option at 1500 itself. So you see 14,700, 300. I gave only 100 points gap. Here I gave 300 points gap. When I shifted my spread 200 points before, I got more credit. That's why my graph is increasing up. What we learned, when we sell, we get credit. When we sell more, we get more credit. So graph goes more up. That's all. No need to get confused too much. Simple concept. So what you are happy that you get more profit. You are happy that your break even is coming closer. But this break even is closer, you are happy. But this break even coming closer, you are just limiting. You are asking your loss to come sooner. That's the meaning here, no? I am here telling that 15,500 beyond I will get loss. But here 15,350 itself I am getting loss. So if you try to be happy here, you have to be little sad here. So ultimately, happiness and sadness are part of our life. We have to balance both. That is why we call this as strategy. So other things are just for academic purpose only. I have tried to reduce the width of this same gap. I have tried to deploy the strike itself at different point. Instead of deploying 14,700, 14,700, 14,700, I deployed this entirely, shifted by 200 points up and observed what happened. So these are all just you take homework tomorrow and you try to work out all these without any example, just with pencil paper you can draw and see. Simple concepts only. So this is what we have to summarize. First, where we started, 315 is my loss. Then what I did, I sold one spread. Okay. What happened, I reduced my loss from 315 to 150. First adjustment I made. Next what I did, I sold. Still I want to reduce. Yes, I am happy. From 300 rupees I came to 3 rupees. Okay. Now after coming this also I am getting a risk. This is long call. This is long call spread. This is long call ladder. Now still I am reducing it by long call iron condor. Here I am buying a spread. Here I am selling a spread. See here I am now reducing from 96, 315 and came to 100. That means 3 months I can survive if I try to risk this amount. But still, what is the profit I am losing? Nothing, no. Long here I am getting profit. That same profit I am getting here also. Little better also I am getting here. When Nifty closes in this region. Only beyond this region you get some profit which is an opportunity loss only. So don't try to look at this strategy as having more legs, complicated and all. Okay. Now this is the same thing. Instead of deploying the sold call spread here, okay, you deploy it. Instead of selling, you purchased a spread. To take credit, you taken another one call which I sold here. Now what I am doing, I am bringing it closer. I am bringing it here. Okay. Now what happens? Rotate down. Further, if you sell call, further it will rotate down. So now what happens? It will come down. There to protect the loss, you buy a call. It will limit the loss. Simple. For this, the books are giving a name called call ratio spread. But you need not remember that and all. All you have to do is how much credit you get, how far you push the break even, how far you adapt your risk reward. That's all. Now what are the all possible combinations? Instead of choosing this strike, you can choose this strike. Or you can choose this strike. Instead of choosing this much width, you can choose this much width. Or you can choose this much width. In all cases, what happens? Another thing in addition is, we can 1, 2, 1. You sell 1, you sell 2, buy 1, buy 1. You can sell 3, you buy 1 here, buy 2 here. You can sell 5, you can buy 2 here, buy 3 here. So this ratio, the number of lots also you can change. Based on that, the slope of this payoff graph will change. So now let us try the same example. I am deploying it at 15,000. Okay. I am deploying a lot at 15,000. Before 200 points I am buying, after 200 points I am buying. So my net debit is minus 569, 469. My net credit is 454. So I have spent 25 rupees from my pocket. So break even depends how much. So this is an example for you. This blue line is always what I discussed in previous slide. The other things are for academic purpose. So what I have done here, I have taken a 200 points wide ratio spread, deployed it at 15,000, deployed it at 15,200, deployed it at 14,800 just to see the peak. All the peaks are almost near. Then what I did, same 15,000, I deployed a 400 wide spread. Instead of 200, I stretched the wings by 200. So here I have written the legend 15,000 plus 200 minus 200, 14,800, 15,200. So what do you see from here? Take that slide, read one by one. What happens to break even? It goes up. What happens to risk? It is here more, but reward is also more. What happens to break even? It is less. So this is non-directional, but these two are directional. If Nifty has to settle here, you get profit, but here you have to settle 200 points more. Practically what it will happen, that bending effect only will happen. Initially it will be like this, then slowly close to expiry will come like this, then finally at expiry this graph will come. So you cannot wait for this peak. Just 100 points if you get also, you will be happy. Okay, this is another combination where I have tried to put the risk more here and I tried to get no profit, no loss, only profit zone. I just skewed my ratio spreads like this. I told no, down you can see no 153, 253 like that. So that is the varying the number of lots I get like this. So now we compare all this at one point. We get a bull call spread, we get a ladder, we get a ratio spread. So all these things what we did as an option buyer, what he did, he started with a buyer, then he did spread, then he did ladder, then he did ratio. Finally he reduced the loss to 48 rupees from 300 rupees. Now as a buyer, if I do all these things, the seller also will do something no, to protect himself. How a seller will protect from him, what strategies he will deploy, that we will see tomorrow. Thank you. Any questions you can ask.
Jananji